Harith is a fund manager of the Pan-Africa Infrastructure Development Fund. That was the Pan-Africa Infrastructure Development Fund, or as we call it, the PAIDF, is an offspring from the Public Investment Corporation of South Africa, who is the fund manager of the Government Pension Fund of South Africa, Government Employees Pension Fund, which is a fund in the region of about $150 billion, depending on whether we're talking today or yesterday. So we're offspring of them, and we closed the fund about 4 years ago. It's a $630 million fund looking to invest in Africa, the whole of Africa. Our mandate covers the whole of Africa, including the islands of Mauritius and Seychelles. And our focus areas are infrastructure. We've currently invested in the region of 60% of the funds in a 4-year space, and we're going into early stage mode of raising the second fund, because we believe by the end of next year we should be fully invested in the PAIDF.
And are your projects mostly, as you said, in infrastructure around project financing? And
well, we're private equity.
Right. But
obviously, okay. It's not project financing, it's not debt financing, it's risk capital.
And again, we talked a little bit about it earlier. What your experience? You've been there for a long time. What have you found from the returns and been pretty good?
Well, I think returns in Africa is always good, because I think Africa, unfortunately, has created a perception of high risk, and that risk has worked into your return rates. So, or the perceived risk of Africa, and it turns out not to be an actual risk in the end. So I think from that point of view, the concern with that, of course, is affordability to Africa.
Right.
Where one gets high returns for the perceived risk, the affordability of what we do. And I'm specifically talking from the infrastructure point of view, where one's got to supply power to a country, one's got to supply roads, transport projects. In the end, affordability becomes a problem.
And are you seeing that the ease of doing deals, as far as all the structuring, et cetera, getting easier or harder, or depends on the country probably?
Yeah, I think as well it depends on the size of the deal, whether we're talking mega project or whether we're talking average size. To use the power industry as an example, which you know very well, if one does a major mega project like Bujagali, I don't know how long that took to close, something like 12 to 15 years. It's very complex, where one focuses more on the 200 to 300 megawatt type of plants, where you work with fewer parties. So doing business in Africa depends on who you work with, how many parties are involved, and how many countries, whether it's a cross-border transaction. So the ease of doing business, in our view, it's not that difficult. One's got to be patient. But in terms of the level of difficulty, I wouldn't rate it very high. I think in terms of infrastructure, what we came across is what you're exactly saying now. The demand is there. So one must look at infrastructure in its different phases, from development, from early stage to financial close, to during the construction period and post-construction in the steady state period. To generate that deal flow, one needs to invest in the early stage. In the early stage is venture capital, unfortunately. The pool of venture capital for that kind of projects are very, very small in Africa. We're currently in the process of putting together a finance company that will fund with partners, with technical partners, the early stage on a venture capital basis. Because one finds that in a big fund like our fund, you've got different investors with different appetite from where to play in the infrastructure cycle. We've got DFIs in our fund that is prepared to take the venture capital, the early stage financing risk, We've got commercial investors, commercial banks that's not prepared to do that. They want to play in the later stage, steady stage phase of infrastructure. So I think in the past what has happened to a large extent is that infrastructure is being treated as a generic sector almost, instead of being treated in terms of the phases of getting infrastructure to market. Getting infrastructure to market remains venture capital, and structures need to be found to look at the wish list of governments in terms of the infrastructure requirements.
I think that's a very good point, and that is that obviously we sell a lot into that space, and putting together, it's a long process of putting together projects to get to the final deal, if you will, even the financing to start building it. And it's a combination of understanding the technical specifications as well as all the legal issues, et cetera, permitting, and it is a big deal, and it's no different than anywhere else in the world. But I think it's just having people that are comfortable in operating in that.
Yeah, I think also one must keep in mind the development cost, and if I say development cost, I'm not talking about the construction phase. I'm talking about the pre-phase, right, until a transaction reaches financial close. That is very high-risk funding, because you only know the day you reach financial close whether you've got a transaction or not. Up to that stage, that money is all at risk. Anytime you probably won't even recover 10% if the transaction doesn't go ahead. I don't know if any of you are cricket fans, but if you're a cricket fan, in our environment, we call it a six or a nix. You either hit the six or you get nothing for the project. So that's high risk, and I think that's what's been missing in Africa. Projects that did happen in that stage is where major sponsors came in and they carried all of that cost and that risk on their balance sheet, because they've got some more upside in terms of construction contracts post financial close, where they could make up for that. As a financial investor, you don't have that, and you just need to get a return on your investment.
Doing business in Africa, you can't afford to be without Africa Investor.